Hello and welcome. Today we have Saurabh Mukherjea with us on an exclusive chat, if I can put it this way.
Thank you so much. Thank you for hosting me. Very kind.
Saurabh, is the market today, are the Indian markets today adequately reflecting the pain in the Indian economy and the imported pain from whatever is happening geopolitically?
I would say yes and no. Yes, insofar as we already had heavy FII outflows. We've already had heavy FII outflows now, Puneet, I think over the last 3 years, right? Pretty consistent now. And not only are those outflows heavy, they're accelerating, right? It's heavy outflows accelerating. So foreign investors clearly have been voting with their feet for several years now. And if you ask them, right, and several of them are our clients, they give us mandates that we manage for them. Their view, Puneet, is that they're saying there's hardly any earnings growth in India to speak of in dollar terms. In dollar terms, last 3 years, there's hardly been any earnings growth worth speaking of at the benchmark level, at the Nifty 50 level. And yet, in spite of the weak earnings growth, the Indian benchmark on a forward PE basis is significantly richer than the emerging market piece. So is the market reflecting reality? Yes, insofar foreign investors are voting with their feet. No. Is the market reflecting reality? No, because there is still heavy domestic inflows, which are keeping valuations propped up at levels which are simply not visible anywhere else in the world. Right? No other large market is seeing 20, 30, 40, 50, 60 PE multiples for companies are growing earnings at barely 15% in dollars. So the domestic piece is a little strange. The strength of the domestic inflows in the face of sustained earnings weakness, in the face of geopolitical challenges, the strength of domestic inflows is perplexing. And the strength of domestic inflows is made even more perplexing in light of RBI data over several years now, that India's net household savings rate is at its lowest in 50 years. And one final way to think about how strange the current circumstances are is, if you look at our latest book Breakpoint, what we have highlighted here is, for the first time since 1991, white collar job growth is close to zero. Given that there are 80 lakh graduates entering the job market each year, with supply of graduates strong, demand weak, real compensation after adjusting for cost of living, compensation has consistently been falling now for the last 8-9 years, falling at the rate of 4-5%. And naturally, if you have a country where real wages are falling, household debt is exploding. So we've shown in Breakpoint that amongst the world's various large economies, we are by far the most indebted. Right? There is no comparison. By the standards of India's own history, current levels of household indebtedness have no precedent. And compared to other countries, these sorts of levels of debt have no precedent. Just to put some broad ballpark around it, in every other large economy, household debt ex mortgages as a percentage of GDP is around 20%. India too was at the 20% mark till 2020, till COVID. Since then, we have run up from 20 to 30 to 33. No other country is at those levels of very high levels of indebtedness. So, is the stock market reflecting the reality of the economy? Yes, insofar as the foreign exits are consistent with everything else we are seeing in the country: weak earnings growth, very few jobs, stagnant wages or falling real wages, high levels of debt. Is the stock market consistent with what we are seeing in the real economy? No, in terms of the bewildering strength year after year now for the 5th year running of strong domestic inflows, which are keeping valuations propped up at levels which seem disconnected with underlying
reality,
stock fundamentals.
So how long will these domestic flows keep on propping up markets? Because someday this realization will also flow to domestic investors, and who may look at reevaluating their investment strategy.
So you asked I think the $4 trillion question. So if we step back, right, a bunch of things have been done to trap domestic capital in the stock market, right? So step one, as I'm sure you know, the local stock market regulator is not allowing domestic mutual funds to put more money in dollar outbound funds, right? So people like us at Marcellus have set up entities in Gift City to help our clients invest abroad. But that's only still a niche activity, right? The core thrust of overseas investment typically happens through SEBI regulated mutual funds, And there, the RBI and the SEBI haven't shown any desire to jack up the limit from $7 billion. So you're naturally, therefore, trapping money in the domestic market. The second piece was a few years ago, the debt mutual fund taxation rules were changed to a level where it doesn't really make that much sense to invest in a debt mutual fund because you end up paying very high rates of capital gains tax, which in turn pushes money into the stock market, right? So both in terms of SEBI regulated mutual funds not being able to incrementally put more money abroad, and in terms of discouraging debt mutual fund investment by high rates of capital gains tax, we are pushing money. I would submit to you, we're pushing money artificially into the stock market. Where does this story break? Difficult to point to specific endpoints, but a combination of sustained weakness in earnings, which is now we are into a third year of weak earnings growth in the country. Combination of that with high CPI inflation. I suspect at the end of April we'll see very high fuel price hikes, as has been seen in other countries. In most other countries, in the wake of the Iran war, fuel prices up 30-40%. I presume at some stage the government will have to allow the OMCs to jack up prices by 30% to prevent the bleed in the OMC's balance sheet. So as we go through the summer with those levels of elevated inflation, I think there'll be a response from the RBI at some stage, i.e. jacking up rates both to dampen inflation, and the RBI I suspect will have to jack up rates to defend the rupee. Maybe that'll be something that will lead to the stock market reconsidering its point of view on valuations. There's another dimension to this, right? Remember, by pushing money away from the bond market into the stock market, we're jacking up the cost of debt capital. We're jacking up the cost of debt capital for everybody, including the government of India.
Yes.
Right. So as we go through the summer, as foreign investors sell, not just in the stock market, but also in the bond market, the government bond yields are running up. The exchequer is finding it more and more expensive to borrow. At some stage, the exchequer will have to reconsider whether they want the stock market, equity stock market piece to sustain, or whether the exchequer wants cheaper cost of debt for itself. And I think this summer therefore will be the hottest summer in several decades for more reasons than one. And investors like are waiting and waiting for opportunities where we will be able to deploy more money in India. In the meantime, we are helping our clients invest abroad into East Asia, into Europe, into America through GIFT City, through our offerings in GIFT City. Back home in India, we are focusing on export-oriented manufacturers because on the back of a falling rupee.
But why you promoting investment abroad at a time when you have a lot of trade agreements in flux, nothing is finalized yet, and rupee dollar again is in a very precarious situation.
So let's just step back and think about it, right?
And doesn't it go against your philosophy of like a coffee can investing, wherein you look at possible domestic winners?
Sure.
And it's like a ad I remember, affiliate, shut it, forget it.
So let's just step back and think about it. Firstly, coffee can investing wasn't born in India. I didn't create it. I would love to say I created it, but I didn't. A gentleman in California called Rob Kirby created it in the 70s.
No, but then
we bought it to India. But coffee can investing's original use and sustained use has continued to be in Western markets, where you have several dozen companies listed in Europe, listed in America, who meet the coffee can criteria, which are established leaders, double-digit top line growth, and return on capital well above cost of capital, right? So the Western markets have for decades now, which is why coffee can investing was born in America in the 70s and 80s, because Western markets for decades now have produced coffee can companies. So in that regard, our investing abroad is in some senses the coffee can going home, right? The second piece was diversification. The Indian stock market accounts for 3% of the world's market cap. America is 55, Europe is around 20-25, and East Asia is around 10-15%, right? So given that for many of our clients, their equity allocation is now a big part of their wealth, having all of your wealth in 3% of the world's market cap doesn't make any logical sense, right? Why would you want all of your wealth in 3% of the world's market cap? Many of our clients themselves told us 4 years ago that they would like to diversify. So some have put 20% of their equity pot abroad. Others have put 30, 40. People like me have put 50% of our wealth abroad over the last 4 years, our equity wealth abroad. And therefore, from a diversification perspective, it makes a lot of sense. You still have the majority of your equity allocation to India, but you have a sizable minority of your equity allocation to markets spread across East Asia, Europe, and America. Remember, even someone like me who has 50% of his equity allocated here, I'm dramatically overweight. India, right? India is 4% of the 3-4% of the world's market cap. Saurabh Mukherjea has 50% allocated to it. That was the second reason. And the third reason is, from what I'm seeing, right, as Indians become more affluent, there's a natural desire for them to see their children study in different parts of the world. There's also a natural desire to buy residences, right? To buy a second real estate. I'm not even sure these are investment. This seems almost like a vacationing property or sometimes a retirement property. And leaving aside these sorts of big ticket requirements such as a university education abroad and a flat in London or New York, there's more practical things like a holiday abroad each year. So if you have a dollar portfolio, given that the rupee since 1991, the rupee has lost 40% against the dollar in every rolling 10-year cycle. So in almost any rolling 10-year cycle, Puneet, the rupee loses 40% against the dollar. If you want to have holiday abroad more, spend abroad more, or sit in India and buy imported phones, imported cameras, imported electronic equipment, having a chunky dollar portfolio helps with all of that. So just from a practical perspective, whether it's a diversification requirement or a need to earn in foreign currency so that you can spend in foreign currency, what we have seen, and I think our competitors have seen the same thing, very strong demand on the part of middle class Indians, upper middle class Indians, to go abroad via GIFT City.
No, but then that portion will be very small of the entire investing population. How many of them would be, wanting to have a home in London or New York for that matter?
So that's why I gave you a spectral requirements, right? So
a common man, a common investor here would still be probably, happy chasing
business standard reader. Every single business standard reader. Let's bring it down even further. Every single Times of India reader, majority of their day-to-day kharcha is in dollars, right? Every single Times of India reader, because there's hardly anything in the life of a business standard reader or a Times of India reader which does not have a foreign input in it, right? So, for example, the medicines that we have in India, even if they're made by Indian companies, 70-80% of the raw materials come from abroad, usually China, sometimes Europe, right? Similarly, if you buy, I own an iPhone made in India. I'm very proud of my iPhone SE made in Bangalore. But 90% of the components of the iPhone are imported. When I take a flight within the country, say I take a Indigo ka Airbus flight, obviously the plane is imported. Every single component of the plane is imported. As we all know, the fuel is also imported. Barring the pilot, nothing else in my air ticket from Bombay to Delhi is really Indian, right? So the common man in India, the common woman in India, the retail investor, the majority of their life's expenditure on consumables is actually a dollar expenditure. And therefore, it makes a lot of sense for them to have a portfolio which is also in dollars. Because if your liabilities are in dollars, increasingly in dollars, but your assets are only in rupee, you're exposed to a brutal currency mismatch, right? A currency mismatch which costs you 40% every decade, courtesy rupee depreciation against the dollar. So that's the actually underlying need to diversify. And this is true everywhere in the world. What's also seen in finance across the world is, in spite of this, there tends to be a home country bias. Now, in India, the home country bias for historical reasons was extreme. Courtesy GIFT City, it started to abate. I think we're only at the beginning of that journey. I think the journey has much further to go. And I think we're getting across, I think, the 5 or 6 GIFT City funds which are outbound at the moment. We're probably, between all of us, we're seeing around $1 billion of inflows. I think this number will potentially grow 10x in the next 10 years.
So does India lack compounding stories now? Let's say now vis-a-vis 3 years ago, 5 years ago.
That's where in Breakpoint, what I'm saying in my podcast, whoever is willing to listen, I'm saying India mein Sagar Manthan hoga. The compounding stories are bound to now shift because of what's happening in the domain of jobs and technology, right? हर जगह हो रहा है, whether it is IT is the most visible story. अभी मैं बड़े फार्मा कंपनी से मिलके आया, उनके सीईओ से मिलकर, तो फार्मा कंपनी सीईओ is being honest. He says for R&D I'm going to use AI. The world's largest pharma companies are using AI, right? जब से बेमिस हैसाबिस एंड जॉन जम्पर को गूगल डीप माइंड के लोग हैं, जब से गूगल डीप माइंड को 2024 नोबेल प्राइज फॉर केमिस्ट्री मिला, and it became apparent that AI can do a better job of drug discovery. AI can do many of the elements of drug discovery better than others. Even in pharma R&D labs, Western pharma companies are replacing human beings with AI, and that trend is now coming to India as well, which is why I was saying I met a pharma company CEO who's saying that he stopped recruitment in his pharma R&D lab, and he's bringing in AI, and there's world-class AI available. Ironically, some of our Western investee companies, Puneet, they've actually created that AI application where they're taking NVIDIA ka GPU, they're taking say Alphabet ka Gemini, and then they're combining it to create AI drug discovery tools for Indian pharma companies, who are then recruiting fewer chemists or pharmacologists, right? Similarly, in HR, right? Increasingly in companies across the world, and again, this trend is coming to India, the whole process of reviewing CVs, scheduling interviews, doing the first round interview, sometimes even rolling out the offer, the entire process is now done by AI, right? So this aspect is crushing job growth in India. It's crushing job growth in the West as well, but it's less of an issue there because they don't have 80 lakh graduates entering the market. As that happens, as job growth gets crushed, as real wages come under pressure, as the whole IT export story becomes more muted, as is evident with every passing result season, right? And which is why I get a little bemused as to why people think this is controversial. Every passing result season, you can see the IT services export story becomes more muted. For us to earn the foreign exchange with which we will be able to afford this camera and the mic we are using, we'll have to find other sources of forex. So either we stop buying stuff from abroad, that's not feasible, right? I don't think Indians will say we'll now just use the Desi stuff. We will still need foreign stuff. So if we want to continue imported stuff, we have to export. If we can't export services, what is the likeliest thing to export? We will export manufacturing. So the combination of the rupee heading towards 100 plus the FTAs that Piyush Goyalji and the government have negotiated, hopefully there'll be more to come, plus China plus one, means there'll be an enormous Sagar Manthan in our country away from services towards manufacturing.
So when this trade deal talks happened, or when the winds started blowing, if I can put it this way, it was said that India will be an alternate to China, to Vietnam, etc. But then nothing much happened on ground as far as reports suggest, and they said that India missed the bus. So by the time we realize and put things on ground that are up and running, all the existing infrastructure with these countries will be miles ahead.
Yeah, so it's very interesting. I think we did miss the bus through the 90s and noughties, right? I was born in 1976. I grew up through the 80s, 90s. Every prime minister that I've seen in my living memory has tried to promote manufacturing exports. Every prime minister, right? Har ek sarkar tries to promote manufacturing exports. Every single one struggles because our currency tends to be overvalued. The reason our currency is overvalued, the reason the rupee gets overvalued is because we export $250 billion of IT services, plus we get $150 billion coming in as remittances from friends and family abroad. So अगर आपके पास $400 billion, $400 billion of inflows into the country है because of our dimag, that jacks up the value of the currency, which makes it almost impossible for Indian manufacturers to compete with Vietnam, Bangladesh, China, countries who structurally devalue their currencies to gain a competitive advantage.
So why and how would this change for India now? What makes you so optimistic?
Because AI is putting paid to our IT services exports, right? So this is how the free market operates. The free market doesn't wait for a neta to do some policy intervention. The free market says AI aa gayi hai. For example, a JP Morgan no longer needs an Indian IT services company to supply 10,000 workers who will effectively use AI for JP Morgan. JP Morgan says, I'll still need Indian IT services, but I'll need far fewer workers, orders of magnitude less. And therefore, on a time and materials basis, Indian IT services firms, please bill me far less. I don't need as many of your workers I used to. JP Morgan will have will use AI. Some of that AI usage will be in JP Morgan's own outsourced facilities in Goregaon, JP Morgan's own GCC in Goregaon. But the orders of magnitude reduction in headcount that the Western companies, that the Fortune 500 companies need, that will mean that we will export less IT services, which will mean that the currency will structurally weaken, which in turn will mean that our exports, manufacturing exports, will finally get the lease of life that they have long deserved.
So how much time would you give the existing IT companies and their setup to probably evolve to whatever global
So lovely
requirement
question.
is?
So if you ask the IT companies, they concede very quickly that they concede off the camera very quickly that they will need to get rid of most of their coders, because as is evident, it's now 3 years into the story. Google, Alphabet, Microsoft, Claude, Anthropic, they have made it very clear that much of the coding will be hitherto done by AI, right? So therefore, you need far fewer coders. Is it 40% less? Is it 60% less? I don't have the precise number, but it is clear that a big chunk of the current installed base of coders in our country will gradually become redundant, right? Now the Indian IT companies pitch number one to people like me is our operating margins will improve because we will need fewer people. We will use technology to get more work done, and therefore costs will reduce, our revenues will stay much the same, and therefore we'll be able to improve margins. The second pitch is to say that, look, AI will create new use cases. So for example, today, an equity investment shop like ours uses AI because LLMs like Claude can chug through 20 annual reports in 2 minutes. But tomorrow, an architect will use AI to create the next, say, parliament in Delhi 50 years hence. And on a third day, a construction company will use AI. Those use cases of AI, construction ke liye, architecture ke liye, those will need more techies working on them. The coding will be done by a Claude or a Chat GPT, but a techie will have to figure out what type of learning machine can create an AI which, say, a construction firm like, say, DLF or Lodha can use to whack its buildings up quicker, right? So the Indian IT services contention is, theek hai, coders will be less. Great news for us, they say. Our margins will improve, our costs will drop, our margins will improve. And then they contend that the amount of AI work itself that will come to them will keep their top line stable. That's their submission. I'm not disputing that submission. I'm in no position to dispute the submission, especially since in several of our portfolios, we own some of the IT services stocks. But my reading of the situation, I've tried to keep it simple and breakpoint is, if you look at headcount numbers, TCS, for example, has 500,000 people. Accenture has around 200,000 people. Um, uh, 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 um, OpenAI has around 2,000 people, and DeepSeek has around, I think, 100 or so people, right? The point I'm making is, yes, I can see that there will be more AI work, but I can also see that the more AI work, it can be done by very, very, very few people, right? कहाँ TCS का 5 lakhs और कहाँ DeepSeek का few hundred people, right? So that orders of magnitude reduction suggests to me that the overall billables of the Indian IT services firms will be under pressure. Alongside the remittances that many of our friends and family abroad that used to send, I suspect they'll also come under pressure. That combined with our relentless hunger for the sorts of imported goods you and I are using for this recording will keep our balance of payments under pressure. The RBI is obviously trying to intervene to stabilize the rupee, but even the last 30 years of data since 91 suggests the rupee gives up 40% of its value in normal circumstances every 10 years. We are now in a structural change, and I submit to you that in the next 5-6 years, the depreciation rate will be a little higher than the long-term average because of the structural change that the economy is going through. Effectively, to use your metaphor, the bus that we thought we had missed 10 years ago, that bus is coming back.
Taking a U-turn.
Right? The bus is coming back. Partly China plus one is responsible, partly AI is responsible. For the manufacturing bus, a depreciated currency, FTA, China plus one, bringing the manufacturing bus back to India. Let's hope and pray that we as a nation don't miss the bus for the second time.
So in terms of AI, if you were discussing, China has shown that they can do whatever US is doing at a fraction of a cost. So in terms of somebody who wants to invest, and you yourself said that you are helping now people, your clients invest abroad via Gift City. Between these two regions, purely on this, where do you stand? Which markets do you prefer and why?
Sure. So two aspects to AI, right? Whilst China has claimed that they have got LLMs, DeepSeek being the most famous one, the the entire hardware stack behind AI is still entirely American, right? Or American slash Dutch. So let's go step by step. We all know about NVIDIA's GPUs, right? Those GPUs are made in TSMC's factory in Taiwan, and I'm sure you've heard, courtesy the US president's intervention, TSMC is also putting up a factory in, I think, somewhere in Texas. Texas या Arizona भूल गया, but अमेरिका में TSMC factory लगा रहा है. So the AI chip is American. The factory in which it is made is Taiwanese, but increasingly under American control because Taiwan is effectively a protectorate of America. TSMC's factories, in turn, are dependent on a machine called extreme ultraviolet lithography machine. So each of these machines is the size of a double-decker bus. Each of them costs $250 million. Each of these machines has 150,000 parts, and these machines are made by a Dutch company called ASML. It's listed in Holland, but it has one office in Holland, one office in America, and the American government has a big say on which country can access ASML's machines and which country can't. And as you would have imagined, 6 years ago, under Trump's first term, the Americans prohibited the export of ASML's machines to China, right? So whilst other countries, China notably, are creating their own large language models, the technology remains, the technology on which, the hardware on which this runs is entirely American, and therefore it's very difficult for other countries to build smarter and smarter language models if the Americans constrain their use of that technology. The second piece is, assume for a moment that we in India want to use DeepSeek, right? We will have to put the data in data centers where the hyperscaler, in this case DeepSeek, will have access to that data. It's not clear to me, given national security concerns, whether Europeans or Americans or indeed Indians will be open to that, right? We've seen what controversy something as straightforward as TikTok has created, right? Both in America and India, right? अगर TikTok को हम data नहीं देना चाहते, it sort of I think it stretches credibility to believe that we will share data with a Chinese hyperscaler, given the security concerns we have vis-a-vis our neighbors on the north. So those are the two sets of concerns which suggest to me that the runway, that the growth runway available to a Chinese LLM, however low cost it might be constrained by the dependence on Americans for the hardware piece, and B, by the apprehension various countries have about sharing their data with a Chinese hyperscaler.
By when do you think the investors will start to question the kind of money that the companies are putting into AI? At the end of the day, they need returns.
I think they are.
Investors by nature are impatient.
I mean, you could argue that investors like us are already questioning it. For example, we are underweight the American AI sector. We don't have NVIDIA in our portfolio, for instance. I think you could argue people like us are already questioning it. I'm sure other investors are also questioning it. What helps the trade sustain? What helps the Mag 7 sustain? And I stress again, we are underweight the Mag 7, we are underweight AI. What helps the Mag 7 sustain is, relative to, say, expensive markets like India, if you leave aside NVIDIA, the rest of the Mag 7 is cheaper than the Nifty. And secondly, the Mag 7's earnings growth is blistering. So now for nearly 8-9 years, they're growing earnings at 18-19% in dollar terms, right? And because they generate from their core businesses, for example, Windows for Microsoft and Search for Alphabet, because their core businesses throw off $100 billion of PAT, they're able to throw that much money back into AI plus borrow some, because if you're generating $100 billion of PAT, the bond market is willing to give you billions of dollars, tens of billions of dollars. So the ability to sustain very strong earnings growth from their core businesses, plus generate bucket loads of cash from their core businesses, is allowing them to sustain these eye-watering sums of money that are being deployed to AI. And furthermore, global scares like the tariff war that Trump triggered last year in 25, like the Iran war, keeps bringing investors back to the Mag 7, right? In fact, to our regret, because we are underweight the Mag 7, right? Because investors get scared. They say, "Arey, nothing else might work in the world. Let's just go load up on Mag 7." After all, they're trading at 17, 18, 19 P and growing earnings at 17, 18, 19%, right? So, wo story, to give them credit, the Mag 7 are sustaining that. And the result of that is something quite remarkable. Till 10 years ago, America used to account for 30%. By America, I mean American listed companies. American listed companies used to account for 30% of the world's profits till a decade ago. That number is pushing 50 now. And very rarely do you see this. Very rarely do you see a country's profit share in the global ecosystem rise so dramatically.
But thanks to
It's technology and technology all the way,
Yeah.
which I think brings us back to the core of the challenge today. Effectively, what Trump is doing, he's able to do because America's tech hegemony, right? That tech hegemony is giving them crazy amounts of power, and for better, for worse, they have a precedent intent upon using this tech hegemony to throw their weight around the world.
Some fund managers believe if the AI fizzles out, the investments in AI fizzle out, or the AI story fizzles out, is when countries like India could be relative safe havens.
So India is clearly an anti-AI trade. Very difficult to argue that. India is clearly an anti-AI trade, but we are, as I said, we are underweight on AI in the American context, and we too have positioned ourselves in a range of sectors which have nothing to do with AI. For example, ultra luxury, right? Rich people the world over, including in India, getting richer. And from the time of the Egyptian pharaohs through to the Mughals, if you make a lot of money, you want to tell the world about it by having expensive things, e.g. pyramids then, and say expensive handbags for rich women in India now. And we're loading up on those handbags, on those luxury watches, on luxury jewelry and so on. I would like to submit to you that expensive handbags which cost a few $1 million have nothing to do with AI. They have a lot to do with man's immemorial need to tell the world that I have arrived. I'm a big man.
So while the LLMs may be, or AI may be hallucinating, the fund managers aren't, for sure.
Yeah, we're trying not to hallucinate. We're trying not to hallucinate. We're trying to keep our feet on the ground. But hey, given the events in the Middle East and given the momentous nature of change, I think whilst AI could fizzle out, it is also true that the speed at which the various sectors are being revolutionized is breathtaking. I gave you the example of drug discovery, right? We have been long-standing investors in Indian pharma, but even a year ago, I didn't know the extent to which drug discovery, I simply had no idea the extent to which drug discovery now is being led by AI, right? And it turns out that you can now replace a big part of the human intervention in drug discovery and simply get AI to crunch through data that will take humans centuries to crunch through, and AI is going through that in minutes, right? So every week we're learning something new about dramatic developments in the world of tech. Some of that drama is already baked into share prices, and hence we're staying away. Some of it isn't, and we're thinking, should we invest by a gift?
So I was about to come to that. What does your investment preference look like? You said you were underweight Mag 7. So what are you underweight on besides Mag 7, and where are you overweight?
So by and large,
in the global context, and then coming back to India.
So we are underweight Mag 7. We are also underweight financial services in the Western world. Where we have loaded up heavily is defense and aerospace, right? So for example, Airbus or Boeing, both Airbus and Boeing have order books full till 2040, right? I'm sure you get to hear about it because every time Indigo talks about its plane delivery, Indigo says that the next batch of Airbuses will be delivered 6 years out, 7 years out, 8 years out, right? So incredibly stretched timelines because the airline companies are backed up to the hilt with orders. In the same supply chain are jet engines, right? There's again two big makers, Rolls-Royce and Airbus. They too have order books full for the next decade or so. Again, duopolistic industries at the aircraft level, at the engine level. Even if you come to components of engines, similar order books, similar duopolistic construct. If you come to something as basic as airline seat belts, again, obviously booming business, but one company supplies 95% of the seat belts in the world. It's a company called TransDigm. So defense and aerospace, both from a civilian requirement level and from every country wanting more fighter jets, right? India, for example, has placed an order for 114 Rafales 2 months ago, the Indian government announced 3 lakh crore order for 114 Rafales. Every country wants more weaponry, drones, fighter jets, and that's creating a boom in defense and aerospace. We have gone overweight that. Second area we've gone overweight is power, because every time Puneet does a AI search as opposed to a Google search, that soaks up 10x the power, right? An AI search relative to a Google search soaks up 10x more power. Ever since ChatGPT hit the world in, I think it was November 22, global power demand has been growing at 4% as opposed to 2% in prior years, right? The extra 2%, 4 as opposed to the Purana 2, means 400 gigawatts of extra power demand every year. So building those power plants, buying turbines to build those power plants, and evacuating the power, transmission and distribution, that whole thing is a $1 trillion annual capex, right? In practical terms, a simple way to put this is, as much power generation capacity has been installed in the last 250 years, that same amount will have to be installed in the next 15 years to cope with the extra power demand that AI is creating, right? So if every person in Bombay, Delhi, Bangalore, Kolkata, if all of us in India's big cities just did one AI search a day, the extra power demand will create would be equal to the production of Belgium, the power production of Belgium, right? That's the extra power demand. So the world over, shortage of turbines, shortage of power plants, shortage of construction equipment, and we are trying to invest into that through a whole range of investments, primarily in Europe, right? This piece is primarily in Europe, to some extent in America. And then the third piece around this is the data centers, obviously, right? So distinct from the LLMs, distinct from the hyperscalers, the data centers require a variety of things, such as gensets, such as circuit breakers, such as connectors, and we're buying some of that. So we're underweight the Mag 7, underweight AI. We share many other people's concerns that the hype around this story might be a little excessive. But there's so much else to invest in the Western world, which costs a fraction of the PE multiples that we have to pay in India, right? 15, 16, 17 PE, and you're getting dollar EPS growth in the high teens. So
But isn't that something like a very converse thing to believe that AI is going to change the world, and then you are underweight AI as things stand?
Not really. So if you go back to the internet, right? Go back to the 90s, and I was just I was in my final year of college. So I saw the beginnings of the internet boom. So a lot of people mistook the internet to be something they could make money from buying, say, Netscape or America Online, right? So people said, internet big thing, America Online le lo, isse kama lenge, right? But it turned out that the internet was a general purpose technology, and all our lives became better. Corporate efficiency in general improved, and credit to Alan Greenspan, he figured this out. One of the sort of big things he became legendary for. He figured out that computers are creating productivity improvements through the mid-90s, and his colleagues kept saying rate badhao, rate badhao, rate badhao. He says, nahi, productivity improvements are coming through. It will keep inflation lower for longer. And he got that spectacular call right. So just like the internet and the improvements in computers proved to be a general purpose technology which benefited everybody rather than specific browser companies, our thesis is AI is somewhat similar. The benefits of AI will get generalized. If drug discovery becomes faster, mankind will get drugs quicker. Pharma companies will benefit. In India, our CDMO investee companies, we're large investors in some CDMO companies in India, they will benefit, because if the pharma companies are doing more drug discovery, there's more to outsource. Mankind benefits because we get medicines quicker. There'll be more medicines going off patent. Cheaper, higher quality drugs will be more ubiquitous. A fraction of that benefit might end up with whichever LLM helped create the drug, and whichever NVIDIA GPU helped do the AI processing for that drug. So the inability to build mental models around new tech, I think ends up costing a lot of people dear. Now, those people who are betting big on AI and AI alone, people who are heavily long NVIDIA, they might have the last laugh. But at this juncture, basis whatever little we understand of the subject, we have chosen to be underweight on AI.
A few years ago, if I remember correctly, you had done a report on how the Nifty construct had changed in 25 years.
Yeah.
So if I were to ask you this now,
Yeah.
that how will Nifty constructs change in,
Yeah.
let's say, 5 years or
Yeah.
10 years
So
from
it's a
now,
good
which
point.
ones
Yeah.
would be
No,
out
lovely.
and which
Thank you
ones would
for bringing
be?
that back. So let me
I mean, these are fantastic,
huh,
but I haven't read.
let me enhance that a bit. I'm glad you reminded me. I'm also getting old, no, so I forget some of the stuff I wrote when I was young. So yes, I did say, and I started doing this 15 years ago. I remember I
Yes,
figured out that
yes,
every 20 years the Nifty changes 50-60%, right?
correct. Yes,
So now, as part of writing Breakpoint, what I realized was there's an even bigger truth. An even bigger truth is large economies, almost all large economies, their whole structure changes every 30 years. Stock market to karta hai, but in a way that's the secondary story. The more breaking news story is the structure of the American economy today versus 30 years ago is chalk and cheese. So if you think about it, America in the 90s was still a manufacturing economy. Then China took the manufacturing away. So America in the noughties became a financial services economy. Wall Street, sattabazi, leverage buyouts, right? Junk bonds, subprime mortgages, collateralized loan or CLOs, CBOs, CDOs, right? So America morphed from being a manufacturing economy in the 80s, 90s to a Wall Street type financial services powerhouse in the noughties. Then Lehman happened.
correct.
And then America in the last 10-15 years has become a tech powerhouse. This is America ka, in the space of 30 years, utter transformation in the American market, and equally visible, by the way, in the identity of the top 10 stocks in the S&P 500. Similarly for China, China was a sweatshop type manufacturing economy in the 80s, 90s, entered the WTO in 2003 after devaluing its currency by 50% in the 90s, right? Between 2003 and 2017, I think their exports compounded in dollar terms at 22-23%. Massive growth in export. 20-22% से totality का exports बढ़ाया dollar terms में. So by 2016-17, by the time Trump came to power, China was no longer a sweatshop. It was a reasonably sophisticated manufacturing economy, which is why Trump and Xi squared off against each other, and Trump won, right? And Trump won. पहला trade war हुआ था 2016 or 2017, ठीक है? And now, as we sit in 2026, China is almost as potent as America in creating biotech drugs. As you highlighted, China is also creating LLMs. China is sending rockets into space. They're sending a moon mission. So China in the space of 30 years has gone from being a sweatshop to being almost at the cutting edge of change, right? So the bigger truth I realized while writing Breakpoint is there is no doubt that the Indian 90s ka model will unravel in the next few years. No country is able to hold the same model together for more than 3 decades. हमारा 3 decades हो गया है. So that model will unravel. The question for investors like us, the question that I think your readers are interested in, is what is the new model, boss?
Correct.
नया model क्या
This
है?
is what I want to ask
There
you.
our submission in the book is this: the new model will have to be around more entrepreneurialism. If there are no jobs, you have to become an entrepreneur. You have to do your own thing. And in the book, we've given plenty of reasons why we think Indians are uniquely suited to that. We are a young country. We've got a great tech stack. We've got a tradition of entrepreneurialism. In specific communities which are not prone to being entrepreneurial, it will be a bit of a challenge. But for the country as a whole, I think this will be a I won't say an easy shift, but this is a shift that we will pull off. Secondly, the economic structure will change from being oriented to IT service exports to being oriented towards manufacturing exports. The economic structure will change from being consumption centric to saving centric, right? The RBI is pointing out repeatedly that net household savings is at 50-year lows. We are pointing out in the book that retail household borrowings as a percentage of income are by far the highest in the world. This is not sustainable. Consumption will have to reduce, savings will have to go up. So 3 big structural changes we would submit to people are around the corner. The fact that change will come, I think, is but inevitable, right? Every large economy changes every 3 decades. We cannot be an exception to that if you want to be a free market economy. The change we submit to you will be around 3 dimensions: the end of office work and the rise of an entrepreneurial culture, B, the fading away of IT services exports and the rise of manufactured exports, and C, the diminution in the consumption culture that has arisen post COVID, and a re-establishment of the traditional Indian thrifty culture, which had made us a country with enormous reservoirs of household saving. Right now, this might not come in 1 or 2 years, but the free market forces which are bearing down upon us are so powerful that over the next 5 to 10 years, I think there's a high chance these forces will prevail. I'm sure there'll be other interesting points of view that will come through in subsequent years on how India will change. Change is the only constant here, and I'm happy to be part of that discourse on the specific contours of that change.
And that's how the Nifty will also involve
Will
in
have to
this
be, right? Naturally, yeah.
constant.
So we'll not be no longer buying, say, Bhujia companies at 100 P. Manufacturing companies which are currently trading at 15 P potentially end up going to
50, 60, 70,
That's
whatever.
right, yeah.
Yeah.
And our job as investors is to be on the right side of that change.
Well, we have run out of time. We haven't run out of questions. Thank you, Saurabh, for your time today.
Thank you, Puneet.
We
Very
hope to
kind.
catch up with you soon again.
Thank you so much. Thanks.